This video marks part 2 of our Introduction to Investing series. We'll be covering commodities, cryptocurrencies, and collectibles in this video. For those who missed part 1, where we discussed funds, stocks, and bonds, we've published a recap video on our YouTube, and we highly encourage you to check it out to catch up on the basics. We will be building upon some of the concepts discussed in that first video, so I really highly recommend you check it out. Given our limited time, we won't be able to do an in-depth exploration of each of these investment options. Our goal tonight is to provide a solid foundation on 3 new investment vehicles, giving you the knowledge to begin exploring and choosing investments on your own. It's important to note that we are not licensed investment professionals, so please be sure to do your own research and speak to a licensed professional before making any investment decisions. Before jumping into any investment, it's crucial to have a clear plan in place. Think about why you are investing, whether it's to buy a home, save for retirement, or simply to build wealth over time. Having a clear understanding of your goals will help you to guide your decisions. It's also essential to recognize that investing always carries risk. You could potentially lose your entire investment, so understanding the risk level of each option is crucial. Some investments come with lower risk, while some are much higher risk. Be sure to thoroughly research before you invest. Additionally, you'll want to consider your investment timeline. How long are you planning to keep your money invested? For example, if you're looking to buy a home soon, you want to avoid having all your money locked up in a retirement account that penalizes early withdrawals. Some investments can hold your funds for decades, so it's important to know that timelines associated with each investment option before you begin. In short, do your homework, make a plan, and ensure that all your investments align with your goals and timeline. I do want to take a brief moment to revisit employer investing because it can be one of the most effective ways to build your retirement savings. Many jobs offer retirement plans that include a company match, meaning they'll match your contributions up to a certain percentage or dollar amount. This is a fantastic benefit because the money you contribute is typically tax-free, allowing you to deduct the invested amount from your paycheck and only pay taxes on your remaining income. Investing in your retirement through your employer should always be a top priority. Not only are contributions tax-free, but your employer is essentially giving you free money by matching these contributions. If you don't take advantage of this, you're not only paying more in taxes, but also missing out on that free match. Each employer may offer different investment options, such as stocks, funds, or bonds, and they are legally required to act in their employees' best interest when selecting these options. Employers have a fiduciary responsibility to ensure that the investments available are sound. So when you're employed, make sure you're contributing to your employer's retirement plan if they offer one. That said, I understand many of us are not employed yet or may work for companies that don't offer retirement plans. So I won't be spending any more time on employer offered investing tonight. However, if this applies to you, be sure to start investing with your company. Do your research on what's available to you and take full advantage of the match. For more details on the employer investment, I recommend watching part 1 of our recap video for Introduction to Investing. When it comes to investing, managing risk is crucial. Nearly every qualified investor, including the Securities and Exchange Commission, which is the regulatory body overseeing the markets, it will recommend you diversify your portfolio to help reduce risk. It's important to remember that every investment carries the possibility of loss, and you could potentially lose everything. We've all heard the saying, don't put all your eggs in one basket. This principle is key when it comes to investing. If you place all your money in a single stock, bond, commodity, or any other investment, you run the risk of that asset underperforming, which could lead to significant losses. That's why diversification is so important. By spreading your investments across different types of assets, you lower the chance of a major loss. Always take the time to research what you're investing in before committing your money. The goal is to minimize risk by diversifying your portfolio, so you're not overly reliant on one type of investment. With that in mind, let's move on to our next topic, commodities. Commodities are raw materials, either used directly, like food, or indirectly, such as gas, energy, and other precious metals. They are essential for human survival and comfort, which makes them a fundamental part of the market and global trade. There are many ways to invest in commodities, but for the sake of time, we won't be diving into any futures or options tradings tonight on commodities. Commodities are generally grouped into 3 main areas: metals and raw materials, energy, and agriculture and food. Each of these categories represents a critical foundation of our society, which is why commodities are considered attractive investments. Keep in mind that commodities are often physical assets, which can add a layer of complexity to investing in them. Investing in commodities can offer unique benefits and risks compared to more traditional investments. For one, commodities can be highly volatile, sometimes offering returns far beyond what you might find in other parts of the market. People need these commodities, so if you own the commodity when a shortage hits, you might make a lot of money. Another key advantage is their ability to hedge against inflation. Since commodities are physical goods, such as gas, electricity, food, their prices tend to rise with inflation. As inflation increases the cost of living, the value of commodities, like food, typically rises as well. We see this in our daily lives. For example, if you own a physical commodity, you might be able to sell it at a higher price over time as inflation pushes up its value. This can help you keep more of your money. Lastly, commodities tend to hold an inherent value. A company can go bankrupt, meaning its stock can be worthless. But a tangible item like a barrel of corn, or a block of gold, or a barrel of oil will always have some value because they fulfill basic human needs. For smart, knowledgeable investors, commodities can provide excellent opportunities to diversify, protect against inflation, and potentially earn above market returns. As always, though, be sure to do your research before jumping in. Despite their benefits, investing in commodities comes with certain risks which vary depending on the specific commodity and the way that you choose to invest in. One major risk is overexposure in a single industry. For example, if you invest heavily in a commodity fund that focuses solely on energy, any fluctuation in the energy market could have a significant impact on your investment. That's why it's important to balance your portfolio with a mix of different investments beyond just commodities. Another challenge is the storage risk. If you physically invest in commodities like gold or silver, you're responsible for safely and securely storing them. This can be difficult and costly, especially for other commodities like food or energy. Theft or damage to these physical assets can result in significant losses, though insurance is available to mitigate some of these risks. Finally, commodities are known for their high volatility. Because they're traded globally, prices can shift rapidly due to factors like supply and demand, geopolitical events, tariffs, wars, weather conditions, and way more. This makes commodity prices especially sensitive to the global economic conditions. For example, a drop in demand for grain in a large market like China could lead to significant price decreases, which would affect your investment. Understanding these risks is crucial. Always research your chosen commodity, its market trends, and the broader economic factors that may affect its value. Be aware of the global and sector specific conditions that could influence the performance of your investment. Investing in commodities can be very different from traditional routes. Since commodities are often physical goods, you can choose to invest by physically buying and storing them. For example, if you have the capital, you could purchase barrels of oil or bars of gold and store them for future sale. However, for most retail investors, the cost of physically buying and holding these commodities is too high and impractical. Many investors instead will opt for precious metals or gems, which are much more accessible for physical purchase. You can buy these commodities often at pawn shops, cash for gold shops, or other large retailers like Costco. While it can be more difficult to buy and sell these assets compared to stocks and funds, some people prefer the security of holding a tangible asset over a stock or fund. It's important to thoroughly research where and how to buy these commodities, how to securely store them, and eventually how to sell them for profit. Another way to invest in commodities is by purchasing stocks in companies that produce, refine, or trade commodities, or by investing in commodity focused funds. For instance, there are millions of companies involved in everything from farming and food production to mining raw materials and generating energy all around the world. By investing in these companies, you're investing in commodities production, therefore sharing in some of the benefits of investing in commodities. While investing in a single commodity can offer higher returns, it comes with the risk of overexposure in one part of the market. For example, if you invest in a company that refines zinc and there's a zinc shortage, your investment could lead to significant losses. Some investors prefer to invest in larger, more stable companies, such as the big five oil companies, because these giants are less likely to fail. The big five includes ExxonMobil, Chevron, Shell, BP, and Total Energies. While these companies offer more stability, it's important to still diversify your portfolio beyond a single sector and companies, even if the larger companies, are subject to less market fluctuations. Alternatively, some investors choose to invest in commodity-focused funds, such as ETFs that track various commodities or invest in a range of commodity producers. These funds offer greater diversification, allowing investors to spread risk across multiple companies and sectors. Popular funds include the ones that we list below, as well as the iShares Global Energy ETF, Vanguard's Energy ETF, and the Energy Select SPDR Fund. By investing in these funds, you leave the selection of individual securities to professional managers, reducing the need for constant research on your part. This is particularly helpful for investors who don't want to spend a significant amount of their time monitoring global market conditions. As you can probably see, commodities are very complex, so having a clear strategy is essential before investing. So we'll talk about two general approaches. The first is investing a small percentage of your overall portfolio into commodities funds. This allows you to benefit from the potential high returns without overexposing yourself to the risks. Choose a general sector or two, like energy or agriculture, and pick a fund that is right for you based on your research. Remember, these funds have different structures, goals, and strategies, so make sure to pick the one that is best for you. Many of the funds that we just discussed are also available in your employer investment options. Remember, passively managed ETFs generally offer the lower fees. And for anyone who missed the first video where we recap these funds, please go watch it. Another strategy is targeted investments in specific commodities. If you prefer to focus on a particular sector, such as gold or energy, you could invest in individual commodity companies or purchase the physical commodities like gold. This requires much more research and knowledge as the factors affecting these companies are numerous and ever changing. I don't really recommend this, but if someone has a lot of time on their hands and wants to dive into this, it's possible. Investing in specific commodity companies can offer greater rewards for savvy investors. And remember, these are just general suggestions. I highly recommend doing your own research and consulting with a qualified investment professional before making any decisions. Next, let's move on to discussing cryptocurrency and its roles in today's investment landscape. Cryptocurrency is a form of digital or virtual currency that uses cryptography to ensure security, making it very difficult to counterfeit or dupe. Unlike traditional currencies issued by governments like the US dollar or the euro, cryptocurrencies operate on decentralized networks built on blockchain technology. A blockchain is a distributed ledger that's maintained by a network of computers or nodes which records and validates all the transactions. Coins are sent over the blockchain to an account's public wallet address for all to see. Coins are commonly mined to be created and spent. For example, with Bitcoin, mining involves using computer resources to solve complex equations that verify the transactions and in turn generate new coins. Some cryptocurrencies allow coins to be minted upon creation as well. Cryptocurrency is a very extensive topic, so we would not be able to discuss more complex topics about cryptocurrency tonight. What sets cryptocurrency apart is that they're not controlled by any central authority, such as a bank or government, which allows for greater transparency and resistance to external control. Transactions are often peer-to-peer and are processed much faster than those in traditional banking systems. Cryptocurrency has grown in popularity due to its potential for high returns, particularly during market booms. Well-known cryptocurrencies like Bitcoin and Ethereum have attracted attention for not just their value, but also for the technology behind them, which is applications beyond currency, such as in decentralized finance. Why we won't dive into any decentralized finance topics tonight, it's an area that's closely tied to cryptocurrency and ever growing. The increasing number of online trading platforms and the wider acceptance of crypto by merchants and financial institutions have also contributed to its growing appeal. However, it's important to remember that investing in cryptocurrency comes with risks, such as volatility and regulatory uncertainty. As the markets continue to evolve, Staying informed about developments and security measures is crucial for anyone considering this type of investment. Why do people choose to invest in cryptocurrency? Many people are drawn to cryptocurrency for its potential to deliver impressive returns over a short period of time. We all remember when cryptocurrencies and NFTs took the world by storm in 2021. Early Bitcoin investors found themselves turning into millionaires almost overnight. Between September 2020 and September 21, Bitcoin's price increased by roughly 80%, and other lesser known cryptocurrencies experienced even crazier growth. This allowed savvy investors to make significant gains with relatively small initial investments. Returns like these are rare, which makes cryptocurrency particularly attractive to risk tolerant investors. Another reason people invest in cryptocurrency is its security. Because cryptocurrencies operate on a blockchain, every transaction is recorded in a secure, immutable ledger. This means that while someone could hack into your account and steal your coins, the coins themselves cannot be counterfeited or altered. The transaction is recorded forever in time on the blockchain. This level of security is appealing aspects for those who are cautious about traditional financial assets like cash or bank transfers. Lastly, the decentralized nature of cryptocurrency is a major draw. Unlike government issued currencies, crypto is not tied to any central authority. This appeals to those who are wary of large institutions or who live in countries where the local currency may be very volatile. If a government fails, its currency could lose all value. Cryptocurrency, on the other hand, doesn't rely on a single governing body and is largely self sustaining, aside from the computer resources needed to mine and trade it. Some investors hope that as cryptocurrency gains wider adoption, its value will continue to rise. As you can see, there are many reasons why people are attracted to cryptocurrency as an investment. Like any investment, cryptocurrency comes with its share of risks. One major concern is that cryptocurrency is still relatively new, and its success depends on widespread adoption. While it was originally intended to function like a traditional currency, its volatile price fluctuations make it challenging to use as such. It's hard to buy something with cryptocurrency when its worth cannot always be accurately determined. Many people invest in cryptocurrency without actually using it for transactions, which has contributed to its inflated market value. If cryptocurrencies don't become more widely adopted, they could lose their value entirely, and investors could face significant losses. Adoption is key for cryptocurrency's survival. Another risk comes from investing in less popular coins. While major cryptocurrencies like Bitcoin, Ethereum, and Litecoin have much more stable and large user bases, there are many lesser known coins that may not survive in the long term. If a cryptocurrency doesn't gain enough traction, it could be forgotten, leaving investors with worthless assets. And this has already happened to many coins, making investing in cryptocurrencies a real danger. Additionally, there are liquidity issues with smaller coins. If you own a large amount of a less popular cryptocurrency, it might be difficult to sell your holdings, which could leave you stuck with an investment that's hard to actually make money off of. This risk is less pronounced with major cryptocurrencies, which have much more active markets. It's also important to acknowledge the criminal activity associated with cryptocurrency. Some exchanges and security measures have improved, but there are still risks of being hacked, scammed, or being defrauded. If someone hacks into your account, they could steal your cryptocurrency, and because transactions on the blockchain cannot be reversed, recovering stolen funds can be extremely difficult. Furthermore, scam coins and rug pulls, which is where a creator abandons a cryptocurrency after profiting from its early investors, are still a problem despite the regulatory efforts to combat them. These risks emphasize the need to thoroughly research any cryptocurrency investment before committing your money. Investing in cryptocurrency is relatively straightforward. Most major brokerages now offer cryptocurrency options, and there are also lots of dedicated exchanges like Kraken, Coinbase, Gemini, and Crypto.com that provide access to a wide range of tokens. These exchanges allow you to purchase and store cryptocurrencies in digital wallets. Like we just talked about, you need to store your coins in some type of wallet. There are two types of cryptocurrency wallets, a hot wallet and a cold wallet. A hot wallet is always connected to the internet, which makes it more vulnerable to cyber attacks. Many of these attacks are very sophisticated in their methods and require lots of resources. So, these attacks usually target much wealthier individuals. For most of us, using strong password methods and enabling two-factor authentication, most of these risks should be mitigated. A cold wallet is a wallet that stores your cryptocurrency offline, which offers better protection but can make transactions slightly more complex. Cold wallets are typically used by investors who want to store large amounts of cryptocurrency for long-term investments. When it comes to investing in cryptocurrency, a smart strategy is to focus on large, well-established coins. Diversify a small part of your overall portfolio with cryptocurrency. These coins have higher adoption rates and are less likely to become obsolete. Popular coins like Bitcoin, Ethereum, and Litecoin are widely traded and considered safer compared to newer or lesser known cryptocurrencies. For most investors, a buy and hold strategy is the best approach as it allows you to weather the market's ups and downs over time. While cryptocurrency is still an emerging market, many experts believe that it will continue to grow and become more integrated into the financial system. I would advise against investing in meme coins or any new and unproven cryptocurrencies. While these coins can sometimes offer off the chart short term high investment returns, they are highly speculative and often lead to losses for the majority of investors. Investing in these coins can be much like gambling, and it's best to approach them with extreme caution. As always, this is not qualified investment advice, so be sure to do your own research and consult with a financial professional before making any decisions. So let's move on to the final part of this video, collectibles. Collectibles are unique, often niche items, either physical or digital, that people gather for various reasons, such as comic books, baseball cards, stamps, watches, cards, video game skins, and more. Unlike raw commodities like gold or silver, collectibles are finished products that are highly sought after by enthusiasts. For some, collectibles are an investment opportunity. For others, they're a way to engage with a passion. The world of collectibles is vast, with countless different types available across the globe. Some collectibles, like watches or clothes or cars, have a huge following and are part of multi-million, if not billion-dollar industries. Others, like Beanie Babies, might only have a smaller, dedicated group of collectors. This makes it difficult to generalize the entire collectibles market, as each one can vary greatly depending on the item and the community of collectors surrounding it. Collectibles are deeply personal and complex, with unique markets and valuation systems. Many collectors spend years absorbing knowledge about a specific franchise or interest due to their passion, making them experts in that particular field. For this reason, investing in collectibles tends to be the most applicable to those who are already part of a specific fandom and are big in that. For instance, if you're someone who's already a big Star Wars fan, Pokemon enthusiast, or part of any other niche group, then maybe investing in collectibles related to your interests might be for you. One of the most appealing aspects of investing in collectibles is the potential for significant returns as market trends shift. When a particular fandom or collectible gains popularity, the value of the related items can skyrocket. For instance, during the COVID-19 pandemic, the watch market experienced a huge surge, with some watches increasing in value by 3 or 4 times their original price. Early investors could have made a 3 to 400% return on their investment while getting to enjoy a product they love. In the world of collectibles, knowledge is key. Those who are the most informed about their chosen niche will often have an advantage in spotting trends and identifying which items will grow in value. Just like in the stock market, where fund managers make decisions based on their expertise, in the collectibles market, you become your own fund manager. The more insight you have, the better your chances of success. Another benefit of investing in collectibles is the enjoyment it brings. Unlike other investment vehicles, where you may simply watch numbers on a screen, collectibles allow you to engage with your passion. Whether it's owning a rare Pokemon card, a limited edition watch, or a vintage comic book, these items hold personal meaning and can be appreciated for their beauty or significance. For many, this adds an extra layer of satisfaction that's not possible with any traditional investment. Which would you rather watch? A fund grow or a piece of art? However, just like with any other investment, there are risks. The value of collectibles can be highly volatile, especially if interest in a particular fandom or item wanes. If the market shifts and people lose interest in your collectible, its value could drop significantly. Unlike stocks or commodities, which have some inherent value, the worth of a collectible is entirely based on what someone else is willing to pay for it at any given time. People's tastes and interests change incredibly quickly, leaving you with an item that may no longer be in demand. This is especially true for more niche collectibles. While larger markets like cars, watches, or sports cards may retain their value over time, smaller or more obscure collectibles run a higher risk of market fluctuations. If you're investing in something more niche, it's important to be aware that the market could shrink or shift unexpectedly. Investing in collectibles can also be expensive. Many high-end collectibles, such as watches, rare cards, or vintage cars, can sell for thousands or even hundreds of thousands or even millions of dollars. This high cost to entry can be a limiting factor, so it's essential to do your research and understand the minimum investment required for your chosen collectible market. Another challenge is liquidity. Unlike stocks or funds, which can be sold quickly, it may not be easy to find a buyer for a high value collectible. For instance, you might own a rare $1,000 Pokemon card, but finding somebody who's ready and willing to pay that amount might take time. In cases where you need cash quickly, you could be forced to sell at a lower price, reducing your potential returns. Finally, there are storage concerns. Just like with physical commodities, collectibles need to be stored properly to maintain their value. Some items require specific conditions, like controlled by room temperature or at a certain humidity level, and they may need regular maintenance as well, such as a vintage car. There's also the risk of theft, which means that you need a way to securely store your items. Before investing in collectibles, it's important to thoroughly research your chosen item, understand the risks of market volatility, the cost of entry, liquidation challenges, and proper storage methods. Investing in collectibles is often more challenging than other types of investments because they are usually physical assets. Unlike stocks or funds, you need to physically purchase and store the item, which can be more complex. Platforms like eBay are among the most popular ways to buy, sell, and trade collectibles. But conventions are also a great option for finding items and connecting with vendors. Make sure to use trusted platforms with buyer production or protection, like eBay, to avoid scams, which are unfortunately common in the collectibles market. Every collectible market is different, so the purchasing process will vary depending on the specific item you choose to invest in. For example, buying rare baseball cards may involve different forums and platforms than buying a vintage watch. This is why investing in collectibles is typically best suited for those who are already part of a particular community or fandom. As always, do your research before investing. Make sure you understand the market, where to buy, and the potential risks involved. Since collectibles markets are so varied, there is no one size fits all strategy. Investing in collectibles should ideally be for those who already have a deep knowledge of their particular interest or niche. One common strategy to get started in investing in collectibles is by flipping items, which is buying them at a lower price and selling them for more. This can be done by identifying undervalued items and reselling them to less knowledgeable buyers. For example, people will often buy sneakers for $100 and resell them for $150. This strategy, known as arbitrage, requires a lot of market knowledge and the ability to spot price discrepancies. It's a challenging method, but can be profitable for those who know the market well. This is also generally how bigger resellers get their start. In this video, we've discussed three types of investments: commodities, cryptocurrency, and collectibles. These investment vehicles tend to have more volatility than traditional stocks, bonds, and funds, which can lead to higher returns but also higher risks. Each comes with its own set of challenges, whether it's the logistics of purchasing and storing physical items or the need for specialized knowledge. Investing in commodities, cryptocurrencies, or collectibles can offer exciting opportunities, but they require thorough research and a deep understanding of their respective markets. These types of investments aren't for everyone, but for those willing to put in the work, they can be both financially rewarding and personally fulfilling. Please remember to do extensive research and consult with qualified investment professionals before making any decisions.